Today we're talking about a common financial strategy, the 60/40 balance portfolio built with stocks and bonds on the premise that this is going to make you feel better, last longer, and have more wealth in the process. That sounds like a winning objective.
Sign me up. Yeah, that's I need that. Yeah.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So the whole 60/40 balance portfolio is a misapplication of Nobel Prize winning PhD work done in the 50s. So the Nobel Prize didn't come till the 90s. It took a lot of us having easy access to computer power that in the 50s was only available in a building sized computer at a university, basically.
Sure. Yeah.
So what basically happened is that the research done was on how do you control volatility, because volatility is what shakes people out of their investment strategy. And if we can dampen volatility, then maybe we can hang on to our equity position with a better probability of a higher outcome.
It's better than leaving. It's better than selling and staying out of the market. But there's a higher cost involved than most people realize. And that 60/40 portfolio was, again, basically produced by Wall Street as a sales pitch to say, leave your money alone. Just leave it here and it'll all work out okay in the long run. So it's a sales pitch. It's not because if you run the numbers, oh, this is a better deal for me. It's mostly Wall Street trying to keep your money out, not in motion. Just leave it with my firm, even though the next firm is pitching the same thing. Leave it with my firm. So there's no big advantage, and they're all shooting for the same pool of cash, but they all want you to invest with them and then leave it alone forever.
And actually, in our professional careers, it took a while to figure that out because we bought the Kool-Aid. We're trained on Wall Street. Yep. We bought the Kool-Aid. This is the way you run money. This is what you do, keep your clients happy. But even then, people would go through a bad period in the market and say, you're responsible, pointing their finger at us. And so we're moving our money. And they'd move from our firm to another firm. And there the sales pitch was, well, Emma, I understand why you're upset. Those guys, they really didn't know what they're doing. What you have the wrong set of mutual funds. And so you go from a balanced portfolio with mutual funds, perhaps at Fidelity, to a mutual fund balanced portfolio at Putnam or American Funds.
Bingo.
Or T. Rowe Price funds. But the model was still the same. It was basically a 60/40 stock bond split on the premise that bonds will protect you emotionally. And by the way, reduce the drawdown in your stock portfolio. So emotionally, you don't panic. That's the whole purpose. That's the sales presentation behind why it is such a common policy recommendation. Not because it's the best thing to do.
No, it's very common, and I've heard it described as financial Xanax. It is just to keep you calm. Don't worry about this. Everything's going to be fine, and that's what, like I said, Don, that's what the 60/40 portfolio is for. It's just to keep you calm down and leave your money alone. And that's it. It's not because it's a great idea for wealth building. It's a great idea for getting you to leave your money alone, and that's as far as it goes, really.
So primarily the model has been used since the early 80s, because prior to that, when interest rates and inflation were high, bonds were losing money and they weren't protecting against market declines when the bonds themselves were declining. So most of the analysis to recommend the 60/40 portfolio starts with the 1980s. It says, well, bonds continue to provide protection. When stocks go down, bonds go up because people rotate the money. That's a fear issue, and there's demand for bonds. And then to avoid a recession, Fed policy is to lower interest rates. That's good for bonds. So they're rising and the stocks are falling in a recession. I mean, it's rational. It seems to make a lot of sense. But when you go back and actually drill down into what the numbers are, what you find is yes, stocks draw down and sometimes they're steep, but historically, when we're using averages, because that's the way the 60/40 portfolio is built, is on averages, stock market declines, while they may be more significant, are shorter in duration. They recover much more rapidly. The
Correct.
problem is, what are you doing with your guts? Down here off the screen. What's my gut reaction to this disruption in my expectation?
Right.
Well, bonds do soften that, and they have since the 80s until recently.
And bonds are currently, recently bonds are in a historic bear market. So they're not fulfilling their traditional role of being a buffer against the equity markets. Uh, they're having drawdown just like equities are, and in some cases larger. And they're also not doing it slowly. There's been some very rapid deterioration in the bond market. So the whole that calls into question for recent history, the whole 60/40, just the concept doesn't even work. It's like it's not a good idea if the bond market's not out of phase with the stock market and doing, if it's supposed to work like if stocks are going down, bonds are going up. But if stocks are going down and bonds are going down, now you have no safety valve. There is nothing there to dampen the reduction in your portfolio, and then the recovery is going to be even slower on the other side because you have that bond allocation, which is going to move more slowly, especially on the upside.
Well, and there's the problem. I mean, I want
Yeah,
to recover, but I've already built in a set of brakes that are not going to let my account recover very quickly. And what we find that today, even professional managers are struggling with their use of bonds. Bonds work if you can have your risk spread over different maturity dates or what's called duration.
sure.
And professional managers are finding that it's damaging to the portfolio to be broadly diversified across the duration spectrum. So they're actively managing an alteration, an intentional alteration away from the theory that justifies being in bonds to begin with. Now, if you're actually dedicated and have a large enough money, a large enough portfolio to live off of the interest at today's rates, you probably don't care. You hold the bonds to maturity, you don't have losses, you just get paid your interest, you get your money back. It's just not adjusted for inflation. Well, in the long run, you have to have a lot of money for that not to be an impact on your life. But most of us aren't Warren Buffett or Charlie Munger accounts. You know, we can't sit still through a multi-year drawdown and say,
Sure.
uh, that won't keep me awake. Everything's going to be okay later, probably than sooner. For most of us and our clients, it's how do we deal with sooner because it seems to show up more rapidly than we had expected. And
Right. And when you dial in the recent returns in the bond market, that's where it really starts to show up, um, because it takes so much longer to recover. And we've got some data that we were running through with the article that we're going through, and peak to trough in the S&P 500 going back to 1946. If we're looking at drawdowns over 20%, it's 12 months. It takes a year to go from peak to trough. In a 60/40 point portfolio, it takes 13 months instead of 12. That's not a lot of protection on the downside. The difference is the break even, going back from trough to peak, from peak to trough and back to break even. If you're just in the S&P 500, it's 21 months, and if you're in the 60/40, it's 28 months. So it takes you're gonna get all of the downside, and then the upside, the recovery is 8 months slower. So it's very difficult. It's very slow on the upside. because it takes so long to recover when 40% of your portfolio is in bonds. Even though you got the downside was almost just as fast. You got a 30-day slower peak to trough, but you have an 8-month slower recovery to break even. I'm not sure that's what people are looking for. I'm not sure they actually done the math on it takes that long to break even, that much longer. A lot of times it's over 40 months to break even from that from the peak to trough. So it's a long haul, and most people don't consider that and think about, well, I'm protecting myself, and it's like, yeah, not really. You have to get used to a little more volatility, and that's going back to 1946. Today, the bond market's not working like that at all. So going forward, those numbers are going to get worse unless we have a reversal in the bond market.
Well, and what's a reversal in the bond market require? It requires falling interest rates. So currently, the debate that's present in the market is that tariffs are inflationary. Whether or not they are is maybe difficult to prove, but that's
Sure.
the assumption. And if we have inflation, the Fed does not want to cut rates. Well, you need rates to fall in order for bonds to do what they're supposed to do in your portfolio. So
Correct.
basically, if you're still holding a major part of your portfolio as bonds, you are betting that the Fed will cut rates and do it soon. When the Fed and some of the regional presidents are saying, yeah, we don't quite see justification for cutting rates, and maybe not even this year.
Right.
We know President Trump wants the Fed to cut rates right away, but the more he says so, the more the Fed wants to look like they're not subject to political pressure and disinclined to do what may, in fact, need to be done in the present environment. If
Sure.
the economy has slowed, not fallen into recession, but slowing down, we want to maintain high employment numbers, growing employment numbers,
You bet.
and lower cost of money for businesses that typically borrow is an important impetus for that to accomplish. And yet the Fed's saying, we're not going to do that. And I'm not going to listen to what the president says because we're independent. We're not political animals. Well, we we don't want to argue that because they certainly look like it from time to time.
Sure. But they've also been on the wrong side of interest rate moves for a number of years now. They totally missed the inflation move up when they said, well, this is transitory, don't even worry about it. And then, oops, we missed that one, didn't we? And so they don't want to be on the wrong side again. So they're going to move cautiously. They're going to be behind whatever's happening. They're not going to try to lead into anything. And that means they're probably going to be late. They're probably going to be late when they're going to cut rates, and they're going to be late when they begin, and they're going to go slowly because they don't want to be on the wrong side again. They don't want to look like they don't know what they're doing, and they're in a very difficult position. And it's almost impossible. They're in a position where to look like they know what they're doing, they know what they're doing. They need to be able to predict the future. They can't. And so sooner or later, you're overcome by events, and you have to move along with the way the economy and the markets are moving. But they're going to stall as much as they can to be as correct as they can, even if they're late. They'd rather be late than wrong.
Well, and the forecast issue is a relevant one because
Yeah.
for during the COVID and denying the presence of inflation data,
Yep.
they basically said we're data dependent. And then the tariffs came along and they said, well, we're going to look and see what happens with the tariffs. So now that's basically forecasting, which means did they abandon their data dependency for a crystal ball that nobody has that works?
Right.
They've actually created part of their own problem here, not only
Sure.
with poor decisions that in retrospect, but presenting themselves as though they know more than they actually do, and
Right.
that creates investor and market confusion, which leaves us in a marketplace that doesn't know whether it should go up or down. This is a period of what we call consolidation for at least the last 3 weeks, and that's the way we
Right.
start the month of June. That's the way we are working our way through what is seasonally a weak period of time in the market anyway. It's summer vacation ahead of us and it rotates through industries. people go on vacation when the weather's good for the most part. We simply have a weak stock market period ahead of us, and we don't have strong drivers. And the bond market is not helping at all in the state of confusion that it is operating in. The professionals in the bond market are uncertain where we are headed, which makes the 60-40 portfolio even more suspect in the current environment.
Yeah.
Thanks for being with us. You want to talk to us about your portfolio? That's what we do. We manage portfolios. We are fiduciaries. We're not brokers. We'll be glad to discuss your positions, how you're making decisions, how we make decisions, what the differences are, and whether or not they'd be a benefit. Contact information follows up on the screen. Give us a call or send us an email. We'll be glad to chat with you on the phone or online with graphics that we'll just share our screen with you. Stay tuned. We have more subjects that we're going to cover in future podcasts. You don't want to miss any of them. Be sure to subscribe. Have a great day.